Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, I'm going to jump into this because we're going to cover a lot today, and I'm going to get, this is one of those times when keep your pen and paper handy. I'm going to make it easy for you as well. As we go through this, I'm going to talk about a lot that hopefully will be of help to you, but also just to get you thinking, have you really looked at your own finances this closely, your own investments in particular in the stock market, and sharing with you some things that maybe you can work into, like hedging strategies as fields, additional ways to manage the risk and getting the returns that you need, that needed rate of return to accomplish your financial goals. So for the first 10 callers to my office, if you would like to get a comprehensive financial plan done at no cost, including an investment analysis, including going over the things I'm going to cover with you today, but on your specific, for your specific portfolio, just call the office, 615-376-5325. We cover a lot in this. It's a comprehensive plan at no cost. This is an opportunity for me to show you what value we in my office can be to you, but also this is an opportunity for us to, get to know each other a little bit. Can I be of value? Am I able to help you with your particular situation that would warrant you wanting to become a client? And, would I like to take you on as a client for that matter? It's a great opportunity, easy way for us to get to know each other and see if there's a good match. If not, don't worry, there's no obligation. Either way, this is a great way for me to add some additional value out there, and sometimes works great for all around. And even if it doesn't, even if it's like, you're in great shape here, stay with what you're doing, you're going to have that peace of mind as well. So it's a win-win all around. And when you come in to see me, by the way, you call the office, 615-376-5325. We got people standing by. Tesla will send you out a checklist of things to bring to your appointment with me. We'll do up all that kind of planning for you. If you're, we're very careful around the office, following the CDC guidelines and everything, but at the same time, so as comfortable as you'd like to be there, we can do it over the phone if you'd like as well. Right now, the offices, of course, are open, and I'm seeing clients on a regular basis each week. So if you'd like to take advantage of it, there's a number, and when you come in to see me, I'll also give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. Okay, right into it. So far, where we left off is the myths. I'm going to recap a little bit. The myths of investing I talked about were stock selection, right? Remember, this was when thinking that which stocks you're going to pick are going to be the determinant of your, or going to help you beat the market. All right, and what we show, in fact, is that just doesn't work. All right, the academic research is indisputable there. You can get an S&P 500 index fund. That index fund has outperformed 90% of equity mutual funds. It's the 500 largest companies in the United States, safe, diversified. It does have a lot of volatility, but not as much as other, comparable mutual funds, or for that matter, when you're looking at any equity mutual fund, you can have a lot of volatility tied to the market. So stock selection, this is a myth. To think that you can hire a money manager that's going to be able to beat the market through picking stocks, which ones are going to win and which ones are going to lose, just doesn't work. Track record investing, that you'd be able to pick a money manager, a mutual fund, based on what their past performance was, and that would somehow be indicative of their future performance. That too is just a myth. It doesn't happen. All right, what we see, in fact, and get frustrated by is we see a particular mutual fund that's beat the market for 1, 3, 5, maybe even 10 years, and as soon as you invest in it, it goes down, right? And that's because they just happen to get lucky over a period of time. There's a random bell curve of chance that just same concept, if you will. If you flip a coin so many times, it'll come up heads, and so many times tails. And if you had 10 people flipping a coin, they're going to have different results. Some might look like they know, they can flip heads all the time. They just got lucky. All right, same thing with track record investing. Market timing, this is one of the worst ones out there as far as myths go. This is where I see a lot of people get into trouble, where they're trying to time the market, when to be in the market, when to get out of the market. The market's going down, I got to get out. The market, I'll wait until it goes back up. You miss a key day. An example of this was March 22nd was the bottom of the market. March 23rd, the market started back up. That one day, the market jumped 12% in one day. That's half of how much it's rebounded since that bottom. So think about that. When it comes to timing, it's just so, it's impossible really to time the market. No one has the ability to do that. So therefore, staying invested is important. And then cost of investing, when you hear advisors saying, oh, these fees are okay because you're going to, when they're talking 3 to 5%, for instance, on a load mutual fund, that these money managers somehow going to overcome that, just not true. You need to be careful. It doesn't mean cost is the most important thing, but it is a consideration when it comes to investing. All right, now, there are 3 academic theories that are going to dispel these myths. So on the next slide, we've got the Matson method, I think, though. No, these are the 3. Okay, and then the next slide is the Matson method. We'll skip to the next one after that. The components, which are 1, efficient market hypotheses, modern portfolio theory, and the 3-factor model. Now, if this sounds complicated, we're going to simplify it quite a bit. Let's start with the academics whose ideas form the basis for this Matson method. And Mark Matson, by the way, that owns a company, it's an investment advisory firm. It's one that we've partnered with over the years, and great guy, good information, and that's why I'm sharing it with you today. So leading academics whose ideas form the basis, that'll be the next slide. These are Nobel Prize winners, authors, and leading academics that created principles which the Matson method is based. Now, one of them is here. We see Dr. Eugene Fama. Excuse me, I'm sorry. That's Harry Markowitz and Merton Miller. They won the Nobel Prize back in 1990 in economics, and this had a lot to do. They're basically considered like the father of modern portfolio theory. And in all these years, what we're seeing basically is how they take that modern portfolio theory and how that's been built upon by other academics. So what we see then is, for instance, Rex Sinquefield and Roger Ibbotson, co-authors of Stocks, Bonds, Bills, and Inflation. These two, and Ibbotson I've talked about before, and Roger has the in addition to being a co-author of Stocks, Bonds, Bills, and Inflation, he's also a professor of finance, School of Organization Management at Yale University, and he owned a research firm which he sold to Morningstar some years ago. One of the best when it comes to bond research, in fact, is Roger Ibbotson. And now on the next one, we also have then, there we go, there's Roger. And this is one of those Stocks, Bonds, their research when it comes to the markets and the difference between equities and fixed is some of the best out there. Then the next one we have is Dr. Eugene Fama, father of the modern efficient market theory and a 3-factor model, co-founder of that with Kenneth French. These two won the Nobel Prize back in 2013. And this is just some of what we see. So when you're looking at these academics, there's been a tremendous amount of research basically done over the last 60 years showing us the best way to invest in the market and how, in fact, to manage risk better in the market. All right, so the next one is efficient market hypothesis. This is so important. So this is the first factor we want to look, or the first principle, rather, that we want to look at. And that's basically, as Dr. Fama said, in a free market, at any point in time, the actual price of a security will be a good estimate of its intrinsic value. Now, another way to use an analogy for that is to think in terms of going to the grocery store. If I go to Publix or if I go to Kroger to get a gallon of milk or a loaf of bread, a pound of butter, whatever it might be, they're going to be priced about the same. So what I'm looking at, because of the competitiveness of efficient markets, and that's what the free market does. It brings these competitive forces together, and that prices it prices all things at a fair market value. To think that way then, or to understand that, is understanding that when it comes to markets, they're going to price things at what they're actually worth. If Kroger, in other words, sold it for a lot more than Publix, we wouldn't go to Kroger, we'd all go to Publix, and vice versa. So there's an example. Now, if you go to a convenience store, you're going to pay more for things because of what? The convenience, right? We're going to jump in, jump out, and it's faster, it's easier, rather than going to the big grocery store. All right, so let's think about this a little bit more. So if you have a potential belief that free markets fail, that the market fails to price goods and services efficiently, that it's possible for some individuals, right, money managers, your advisors possibly, to identify in advance which prices are inaccurate. In other words, that stock's priced too much, or that price is too low. This is a great opportunity to buy something that is mispriced. That managers seek to increase returns and avoid losses by taking advantage of stocks or market mispricing. Now, people with this view are going to basically follow the myths that we talked about, right? They're going to be looking for stock picking opportunities. They're going to be looking to time the market, as an example. So if you believe then that the market is inefficient, then you're going to be using those strategies, and you're going to be in that what many people have done over the years. Now, the alternative belief is that free markets actually work. Okay, and this, going back, Vanguard was the first company. They're kind of like the innovator and creator of index funds many years ago. So here, this is one of those areas with index funds that your belief is in that free markets actually work. That the free market is going to be the best determinant of market prices based on supply and demand. So right now we've got an upcoming we've got a meat shortage right now, so we may see meat prices go up. And then what happens when they correct that, and there was a news report on today that it's probably only going to be for a few weeks, we'll see prices come back down again. All available information then is going to be factored into the current price, so that how you're getting that meat to market kind of thing, all of those factors come into play, and that's how that price comes into play. Only new and unknowable information and events then change pricing. We can think about that with the virus, right? When it was an unknown, it didn't affect anything. Once it became known and the impact it was going to have, all of a sudden you see how it has affected our markets. So the randomness of the market makes it impossible, though, who could see these things coming, right? For any individual or entity to consistently predict market movements and capture additional returns unrelated to risk. So people with this view would utilize free market investment strategies. We're going to take a break. When we come back, I'm going to share with you what those free market investment strategies would be. But first, a break. Join me here. I'll be right back on the Retirement Report.